This meeting was very hawkish. We had a 75 basis point rise bring the Fed funds rate between 3 and 3.25%, which was largely expected. But a lot of the commentary, especially on how far we expect rates to go, was very hawkish. Powell said at some point it will be appropriate to slow the increases, but he will be data dependent, and we should expect at least 100 to 125 additional basis points in 2022. So that's fairly significant. We only have 2 more meetings. That means it's 75 and another 75, another 50, 125. There's a lot of different ways to get there. But it means that we're likely going to be between 4 and 450 going into 2023, which is fairly significant. We should expect restrictive policy for some time, which means we should be seeing meaningful downward pressure on inflation, which we have been seeing as of late. Maybe not as meaningful as many would hope, but there has been some downward pressure. And Powell noted this when he said that we're likely at the lowest level of restrictive right now. And he also said that we could likely reach 4.6% in 2023 on the Fed funds rate. So that would be, if we go do another 100, 125, that means we should expect another 50 at least in 2023 if it's likely that we're going to reach 4.6%. Now, there was a lot of questions on long and variable lags. We've done a lot of tightening here in 2022, and it hasn't all showed up in the economy and the data yet. Powell dodges these questions a little bit, but he understands that there are long and variable lags to interest rate increases on inflation. And it leads the Fed to believe that at some point they're going to have to slow and then pause interest rate increases. Now, again, this doesn't seem like it's going to happen for at least another 150 basis points. But they will be looking for broad decreases in inflation and a softening job and labor market and below trend growth. The Fed does not expect to reach their target inflation of 2% until 2025. So the Fed does believe it's plausible to have enough softening in the labor market that it does not have a recession, although it seems more and more unlikely. Expectations for the labor market to soften next year with employment reaching 4.6%. The recession risk will not stop the Fed from pursuing the 2% inflation target. So again, this was a hawkish meeting, and they are hell-bent on reaching that 2% inflation target based on their commentary. The stock market was volatile before, during, and after the meeting, drifting higher, then lower, then higher and lower again. So it's really hard to dissect in real time how the market's pricing the meeting. But the 10-year rallied some while the 2-year sold off, reflecting a higher Fed funds rate for the next 2 years, which was consistent with the commentary that we just talked about, and a softening of longer-term inflation expectations, leading to a rally in longer-term bonds, which makes sense with the meaning that's this hawkish. One comment that he made towards the end of the press conference that I thought was interesting were his comments on the housing market. He mentioned that he expects the housing market will likely go into a correction, and given the housing market's impact on the economy, I thought this was very bearish for the economy and earnings going forward, and a little bit of a surprise. You saw the market actually sell off fairly significant as he was talking about it. There's a lot of information here. Generally speaking, a very hawkish meeting, putting downward pressure on longer-term inflation expectations, while having a sell-off in shorter-term bonds. So continues to be an interesting year from the Federal Reserve.